Is it time to buy this fantastic company, BlackRock? It is down 12% year to date with a yield of just over 3%. And I think now is a good opportunity to add BlackRock to your portfolio. We're going to take a look at the historical performance of the stock. We're going to jump into their income statements, their top line revenue and bottom line net income growth year on year. We're going to look at the health check of the company, look at their total cash versus total debt. We're going to take a look at some of their competitors, how they've performed total return year to date, as well as over the last 5 years. We're going to take a look to see what are insiders doing. Are they buying or selling? We're also going to see the perspective from the institutions. Are they buying? Are they selling? This is going to lead us nicely into that all-important dividend safety score, as well as understanding some very important financial metrics and dividend metrics you need to understand before investing in this company. And as always, we will run it through our stock valuation model, getting to our intrinsic value and understanding the acceptable buy price given our margin of safety. Now, it is down 12% year to date towards the mid to lower end of the 52-week low with a yield of 3.2%. Now, is this a cheap price? Can we expect to see this increase over the next few years, as well as seeing this yield on cost and double digits? Well, investors who have been holding the company over the last 10 years would have seen an increase of around 108%. Now, with the dividends not reinvested, it's not a bad return on investment, but ideally we would be looking for a lot more. And as we can see, it did at the end of 2021 hit nearly $1,000, just shy there at 971. So can we expect to see some nice strong growth over the next 10 years, both on the share price as well as that dividend yield? Jumping into the income statement, so we like to see around 3 to 7% growth year on year on the top line. December 2018, 14 billion reported. December 22, 17.9 billion. So there's been some nice growth over the last 5 years. But on a more granular level, what we can see from December 2018 to 19, relatively flat before picking up to 2020 and beyond. But then from 21 to 22, we do in fact see a decrease. So slight inconsistencies year on year, and we'll look at the last 10 years percentage-wise too. But overall, we can in fact see it is slightly inconsistent. Bottom line net income, 4.3 billion reported December 2018. Latest annual report, December 22, 5.2 billion. Again, moving in the right direction, positive to see. And again, what we can see, it has increased their bottom line from December 2018 to December 21, without then having a small drop in 22. So the income statement, there are some slight inconsistencies, but it is important to note it is increasing year on year in the right direction. Now, in terms of a health check on the balance sheet, total cash versus total debt, December 2018, 6.3 million or billion, in fact, held on the balance sheet. Latest quarterly report, 6.6 billion. So a very small movement in terms of the cash held on the balance sheet over the last 5 years. And how does that compare directly numerically to the total debt? Well, we can see here total debt just shy of 5 billion in December 2018 and essentially doubled in their latest quarterly report to around 10 billion. So the cash has So whilst we see essentially the cash position stay relatively flat, their total debt has doubled, and we will touch upon that shortly. In terms of how they have performed against their competitors, well, we have a few here to see: Blackstone, KKR&Co, Brookfield Corporation, and a few others. Year to date, we can see total return BLK down 8%, which is essentially the worst performing out of their competitors. And now if we do take a more broader look at the last 5 years to see how they have compared in relation to their competitors, we can see BLK up 79%. Again, interestingly, whilst it's not the worst, it is the second worst performer of their competitors, with the highest being ARES. So again, whilst previous or historic data isn't necessarily indicative of future performance, it is interesting to see. Now, in terms of insider trading, well, what we can see straight away, current insider ownership just less than 1%. And over the last few years, as we can see, they have been selling around 91 million. Now, it's not a massive amount, but it is just there to show you that insiders over the last few years have been selling. But in the grand scheme of things, I wouldn't say this is really a red flag indicator, but just interesting to note. In terms of institutions now, well, what we can see, they've institutional ownerships is sitting at around 77%. And more importantly, over the last 12 months, 36 billion worth of shares have been sold. But more interestingly, in fact, 75 billion have been bought. So institutions are buying more than they are selling. And with the latest Q2 of 2023, 69 billion worth of shares have been bought, whilst 32 billion have been sold. Again, this isn't necessarily an indicator just because institutions are buying, but it is worth just seeing there to understand the broad picture in terms of what insiders and institutions are doing. Now, in terms of dividend safety, it has a score of 98, making it very safe. Market cap 93.5 billion, making it a large cap company. Now, in terms of essentially recession metrics, for those that believe a recession is due or looming, they maintain their dividend during the 07-09 period. Negative 22.5% sales. However, do note that was the average growth of companies during the 07-09 recession for S&P. And we can see the recession return negative 50%, which did beat the S&P's 500's negative 55% return, but again, still very poor. Just something to digest for those investors who see a recession on the horizon. So they have been increasing their dividends for the last 13 years. The latest increase this year, 2.5%. Very, very slow, very small. Last 5 years, however, 14% double digits that we love to see. Last 10 years, 13% again that we love to see. One thing that I do note for the new viewers, you want to be aiming for a minimum of 4% increase in your dividends, your salary, and your other income producing assets. The reason for this is due to the fact that the US inflation rate over the last 40 years was 4%. So anything less, you are in fact taking a pay cut and losing your purchasing power. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. So we have our first sign here of undervaluation. But do bear in mind that we never look at any models in isolation and will draw a conclusion towards the end of the episode. Likewise, forward PE slightly lower than the 5-year average at 18.6. And we can see the sector PE at 9.8 versus BlackRock at 17. Now, as I mentioned, it is trading towards the mid to lower end of the 52-week range, but understand 52-week low does not signal undervaluation. Likewise, 52-week high would not signal overvaluation. Now, earnings versus free cash flow. Earnings is strictly just there for investors that like to look at those metrics. But as I've mentioned in previous videos, it is susceptible to manipulation by management through accounting. So we'll draw our attention to the free cash flow. Personally, below 60% is what I like to see, just because it means there is room for the company to grow those dividends to double digits that we like to see. For the large part, it has been around 60%, 2020 at 63, 21 at 55, 22 at 67. But interestingly, 23 is expected to drop to 47. So I would like to see a larger increase in January 24, over 4% indeed. In terms of the earnings per share, again, the data is there for investors that like to look at that. $20.80 in 2013, $29.30 in 2022, and expected 23, a large $42.90. But again, what we can see, it is fairly inconsistent. From 2013, this was dropping to 2016. And again, we can see whilst it does increase, there are large increases over the last 10 years. So do bear that in mind. Now, as I mentioned, 3 to 7% growth is what we like on the top line. For the large part, they have done that and even higher on most years, as we can see, 2013 to 14, 2016 to 17, and 2020 to 21. But then we see a negative growth year in 2022. So in terms numerically, 10 billion top line in 2013, 18 in 22, so nearly double the top line over the last 10 years. It is positive to see that the top line is moving in the right direction. Now, yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. So what we see here, 174 million to 152 million in 2022. Not the largest amount of share buybacks over the last 10 years. So really nothing to note. Whilst it is positive, we do see them at least buying some shares. ROIC, return on invested capital, one of my 7 golden dividend metrics. If you haven't seen the other 6, do check the pinned YouTube video. 10% plus is personally what I like, as it means management are able to effectively allocate their capital. And what we can see for the large part is 10% plus year on year consistently. So very, very positive to see. Gives me faith in management. Now, when we take a look at the operating margin and free cash flow margin, again, consistently above the minimums that we like to see. So again, gives me faith in management and the way the company is run. And on top of that, when we see higher operating margins, it means that bottom line net income will also be higher, therefore leading to more dividends and dividend growths. Now, net debt to earnings for interest, tax, depreciation, amortization. Now, whilst we did see that total debt double, 1.5 is the highest of what we look for. So 1.5 essentially being the number of years it would take the company to pay off all their debt net of cash on hand. In fact, 2022 would only take them 0.15 years and 23 expected 0.51. So there is no real worry in why we can see that high dividend safety score. Now, in terms of net debt to capital, purely showing us the percentage of a company's financing from debt as opposed to equity. As always, if you do enjoy the content, value is being provided, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model to get your own intrinsic value of companies in your portfolio and your acceptable buy price, do click on the pinned comment below. Now, the first model we're using today is Graham's valuation, where we put in the stock ticker BLK, earnings per share at 34.27, with that growth rate per analyst estimates at 10. Current yield on AAA corporate bonds at 5.4, giving an intrinsic value of $475. Now, what we can see that is lower than the current trading price, below the 52-week low, showing signs of overvaluation in the current market. As always, though, do bear in mind we never look at any of these models in isolation, and we'll draw our conclusion towards the end of the episode. So we move on to the second model, the multiples valuation model. Companies in a similar sector and size. We have State Street Capital, KKR & Co. and T. Rowe Price. We have their stock price EPS to get their P multiples. We get the average multiplied by that of the earnings per share of BLK to get a multiples valuation price of $809. Now, when we take a look, that is some significant growth to the current trading price, above the 52-week high, and again showing signs of severe undervaluation in the current market. We then move on to the third model, the dividend discount model, where we see the yearly dividends. Last year's, or essentially the beginning of this year, was fairly poor, below inflation, but on average around 10%, which is very positive to see. Forward looking, I've gone with 6% estimate, but again, if you grab a copy of the model and you want to justify a higher or lower percentage, you can do that and play with the figures. This gives a DDM price of $1,000.60, strong upside to the current trading price, above the 52-week high, again showing some severe signs of undervaluation in the current market. We then move on to the DCF model with free cash flows year on year. Average growth rate 6.5%, with analysts forward looking estimating 8%. In conjunction with our discount rate, we get the present value of future free cash flows and terminal value, add them together with the cash, subtract total debt, arrive at the equity value, divide that by the shares outstanding to give a DCF price of $807. Again, nice upside to the current trading price, above the 52-week high and showing signs of undervaluation in the current market. Now, the intrinsic value, as mentioned, is the average of the four models that we have just run through. And as always, if you do enjoy the channel, value is being created, smash the like button. It really helps the channel grow. And if you do want to get regular videos notified to your doorstep, do hit the subscribe and bell button. So intrinsic value coming at $787. Now, current price trading around $640. If you wanted a margin of safety of 10%, which is what I'd advise if you believe it has a wide moat, strong financial metrics, good forward-looking data, then you'd be a buy up to $709. If you were looking at 15%, then it'd be a buy for you up to $669. And at around 20%, a buy up to $630. Now, when we take a look, $630 is exactly what it was on Friday before the market opened today. So again, it is very near to the current market price. For those looking at 25%, your acceptable buy would be around $590. And we can see that's still within that 52-week price range. Now, personally, I do believe this is a very strong stock to have in your portfolio, and with a margin of safety of 20%, it is an acceptable buy, not far off the current trading price. As always, though, do let me know your thoughts in the comments below. Are you looking to buy, looking to sell, or purely on the sidelines speculating? Wall Street do see some nice upside to the current price at around $779. Again, not far off our intrinsic value. Now, as always, if you do want to run your own companies through the intrinsic value calculator to get your own acceptable buy price of companies in your own portfolio, or even BlackRock, do click on the pinned comment below. And as always, if you do want to join us in the Patreon to talk about all things finance and stock market related, do click on the below Patreon link and I'll see you there. As always, have a great day, take care, and catch you on the next episode. Goodbye.